Okay, now we'll compute and evaluate variable and fixed overhead variances. So the variable overhead rate variance, so we've got variable overhead rate and efficiency. All right, so this would be related to, here we've got actual rate minus standard rate, and the efficiency variance is related to the time used, so it's actual hours minus standard hours. Okay, so the variable overhead rate variance is the difference between the actual variable manufacturing overhead costs incurred and the amount of variable manufacturing overhead expected. Okay, so you take your actual hours times the difference in rates, actual rate minus standard rate. Sorry, and this is also called the variable overhead spending variance. Now for efficiency variance, that's the difference between the actual amount of allocation base used and the standard allocation base used for the actual production volume. Okay, remember it really is a flexible type variance. So this would be your standard rate times the difference between actual hours minus the standard hours allowed. And here's our example. We've got 31,000 cases produced. The standard overhead rate is $25 an hour. The standard hours required per case are 10 cents per per machine hour, so a tenth of a machine hour. The actual machine hours are 3,000 machine hours, and the actual variable overhead costs are 85.2. Okay, that's our actual cost, and that results in an actual variable overhead rate, okay, of $28.40 per machine hour. So, I mean, this is given to you here, but I've got actual hours times the difference in rate. So my actual hours are 3,000 machine hours times the $28.40 that we had to calculate minus the standard variable overhead rate of 25. So that's 10,002 unfavorable. And this is actual, so this is 3,000 times 28.40 is higher than what was planned. Okay, so that would mean that the variance would be unfavorable. And here's the efficiency side of it. Everything is the same here except the actual variable manufacturing overhead cost 85.2. Is that what we had? Yeah, 85.2. So standard rate times the difference in hours. And our standard rate is $25. The actual machine hours are 3,000. And what should they have been? For the actual units produced, in this case cases, the actual cases produced of 31,000, it would be times the standard hours per case, 0.10. All right, gives us $2,500 favorable. And this summary is the same as what we saw before for material and overhead. It's, you know, it's basically the same formula, or material and labor, this is the same formula just being reapplied. So in this case, I've got actual hours and actual rate, actual hours times the standard rate, and for the standard cost allowed, standard hours allowed times the standard rate. Okay. And the rate variance plus the efficiency variance would give you the total manufacturing overhead variance. Okay. Now for fixed overhead is a little strange. The fixed, we've got budget variance and volume variance. And the budget variance is the difference between the actual overhead costs incurred and the budgeted fixed overhead. Okay, as simple as that. Actual minus budgeted. The fixed overhead volume variance is a little bit different. That's the difference between the budgeted fixed overhead and the standard fixed overhead costs allocated to production. So budgeted fixed overhead minus the standard. So this would be standard hours allowed times the standard rate. Okay, and again based on our actual production. So here is some volume variance. This company actually produced 31,000 cases, standard hours allowed of 0.10 machine hours per case. The fixed manufactured overhead rate is $9 per direct labor hour. So we had 31,000 hours, no cases, sorry, 31,000 cases times 0.10, okay, would give us what, 3,100 cases times $9 would give us 27,900 for our actual standard fixed manufacturing overhead. And the budgeted would have been the standard fixed manufacturing overhead of 30,000 minus the 29,000 that we calculated up above. Okay, that would have been our standard fixed manufacturing overhead. So that's budget minus standard, or 2,100 unfavorable. Okay, in this chart again summarizes where you are. And this is another good way to look at this, is that if the production volume is greater than you thought it was going to be, then fixed overhead has been underallocated. Okay, if the actual amount this is greater, and the fixed overhead volume variance is favorable. If the fixed overhead has been is less than anticipated, okay, production volume is less than anticipated, then fixed overhead has been underallocated, and the fixed overhead volume variance would be unfavorable. This will take you some thought. Okay, first of all, practice the questions and then come back to this. And that's it.